90% of retail traders never become consistently profitable. That number has been roughly the same for decades. Better technology, more education, more content, more tools, and the failure rate stays the same. That should tell you something important. The problem is not information. Most traders today have access to more trading knowledge than professional traders had 20 years ago. The problem is something else entirely, something that more information alone will never fix. Today, I am going to show you exactly what that something is and give you the specific path out of it. In the next 18 minutes, I am going to walk you through 3 specific reasons why most traders never cross the line into consistent profitability, not surface level reasons. The deep, psychological, behavioral reasons that keep capable, intelligent, motivated people stuck in the same place year after year. Each reason comes with a real trader story, the exact psychology behind it, and the specific change that fixes it. By the end of this video, you are going to understand the actual gap between where you are and where you want to be. And more importantly, you are going to have a clear, concrete path across it. Let's get into it. Let me tell you about Brian. Brian is 34 and has been involved in trading for 3 years. He has taken 4 separate courses. He has read 11 trading books. He follows 23 trading educators on social media. He watches an average of 2 hours of trading content per day. His knowledge of trading concepts, psychology, risk management, market structure, position sizing, trader mindset is genuinely impressive. If you sat down and had a conversation with Brian about trading, you would think he was a sophisticated, well-educated trader. His live account after 3 years is down 31% overall. Not from catastrophic losses, from a slow, consistent pattern of making the same mistakes repeatedly. Mistakes he can identify and articulate perfectly when reviewing sessions after the fact, but cannot seem to stop making in real time. Brian's problem is not a knowledge deficit. Brian's problem is a knowledge to behavior gap. He understands what correct trading looks like. He cannot consistently do it. He can explain loss aversion to you. He experiences it on every losing trade. He can describe the danger of revenge trading with precision. He revenge trades anyway. He knows exactly what a process-focused mindset looks like. He monitors his P&L obsessively during sessions. And here is the pattern that has kept Brian stuck for 3 years. Every time he encounters a period of underperformance, his response is to acquire more knowledge. He finds a new course. He discovers a new educator. He reads a new book. The search for the missing knowledge that will finally fix his trading feels productive. It generates the feeling of working on the problem. But it is not working on the problem. It is avoiding the actual problem, which is implementation, not information. Brian does not need to know more about risk management. He needs to follow his risk rules on his next 50 trades. He does not need to understand more about trading psychology. He needs to apply the psychological principles he already understands to his next 10 sessions. The gap is not in his knowledge. The gap is between his knowledge and his consistent behavior. Here is the question worth sitting with honestly. How much trading knowledge do you currently have that you are not consistently acting on? Not knowledge you are still acquiring. Knowledge you already possess that is not showing up in your actual trading behavior. For most traders, if they are honest, the answer is a significant amount. They know the rules, they know why the rules matter, and they break them anyway, regularly, predictably, and then they go look for more rules. This pattern, endless learning as a substitute for disciplined implementation, is one of the primary reasons most traders never become profitable. Because profitability does not come from knowing the right things. It comes from doing the right things consistently. And doing the right things consistently requires a completely different focus than learning the right things. It requires behavioral practice, structured repetition, accountability mechanisms. These are the tools of implementation. They are not the tools of information acquisition. And most traders never make the shift from one mode to the other. Why it happens psychologically? The endless learning trap is driven by two powerful psychological forces. The first is what researchers call the illusion of competence through familiarity. When you learn about a concept, loss aversion, for example, your brain creates a memory representation of that concept. Over time, that representation feels like capability. Knowing about loss aversion starts to feel like being immune to it. Reading about discipline starts to feel like having it. The familiarity that comes from repeated exposure to a concept creates a false sense that you have integrated the concept into your behavior, even when your actual behavior contradicts it clearly. The second force is something called avoidance through productive feeling activity. Implementing trading knowledge is uncomfortable. It requires sitting with real market uncertainty, real financial risk, and real emotional discomfort and making correct decisions despite all of that. Learning about trading, by contrast, is relatively comfortable. It is intellectually stimulating. It generates the feeling of progress, and it can be pursued indefinitely without the specific discomfort of implementation failure. So when implementation gets hard, when the trading does not go well, and the emotional difficulty of correct execution is high, the brain finds its way back to learning mode, which feels like working on the problem while functionally avoiding it. The exact fix: Brian needed a 30-day implementation moratorium. Here is what that means. For 30 days, no new courses, no new books, no new trading educators, no new content, zero new information input. The entire 30-day period is devoted exclusively to implementing one specific principle from the knowledge he already possessed. He chose the principle he knew was most impactful and least consistently applied: the 1% risk rule. For 30 days, every single trade, regardless of how he felt about the setup, was sized at exactly 1% of his account. No exceptions. No high conviction upsizes. 1%. Always. He also built a simple daily accountability mechanism. At the end of every session, he wrote one sentence: did I follow the 1% rule on every trade today? Yes or no? If yes, the session was a process success regardless of P&L. If no, he wrote specifically which trade violated it and what mental state drove the violation. At the end of 30 days, Brian had followed the 1% rule on 94% of his trades. His account had grown slightly. More importantly, he had spent 30 days building an actual behavioral habit, rather than adding another layer of knowledge to a foundation that was already strong enough to support consistent profitability. If he would only act on it. The principle scales to any rule you are not consistently following. Pick one. Just one. The most important one you already understand but do not consistently apply. Build a 30-day implementation, focus around it exclusively. No new information, no new frameworks, one rule. 30 days. Consistent behavioral practice. That is the mode shift that separates traders who keep learning from traders who start earning. The gap is not between what you know and what you need to know. It is between what you know and what you consistently do. Pick one rule you already understand but do not consistently apply. Run a 30-day implementation moratorium. No new information, one rule: daily accountability. Consistent behavioral practice is the only path from knowledge to profitability. Meet Lauren. Lauren is 29 and has been trading live for about 16 months. She reviews her trading regularly. She is more reflective than most traders at her experience level. She takes the review process seriously. But her results have been frustratingly flat for the past 6 months, despite genuine effort and genuine reflection. When I asked Lauren what she measured when reviewing her trading, her answer was immediate. She tracked her daily P&L, her monthly P&L, her win rate, and her overall account balance. She reviewed these numbers after every session and every week. She had spreadsheets. She had charts of her account growth over time. She was measuring consistently. She was just measuring the wrong things. Every metric Lauren tracked was an outcome metric. It told her what had already happened. It gave her no direct information about what she was doing that caused those outcomes, and therefore no clear path to improving them. When she had a bad week, her outcome metrics told her she had a bad week. They did not tell her whether the bad week came from poor setup selection, from emotional mismanagement of valid setups, from position sizing errors, from session timing problems, or from any other specific behavioral cause. The outcome data was real. It was just not actionable. Here is an analogy. Imagine a basketball player who, after every game, records only the final score. Over months, they accumulate a record of wins and losses. They know they are losing more than winning, but they have no data on their shooting percentage, their turnover rate, their performance in the fourth quarter versus the first, or their defensive statistics. The scoreboard tells them they are losing. It cannot tell them what to practice to stop losing. Outcome data without process. Data is a scoreboard without a practice plan. Lauren's trading was the same. She knew her results. She did not know which specific behaviors were producing them. And without knowing which specific behaviors were producing the results, she had no concrete target for improvement. Just a vague awareness that things needed to be better. Do you track your trading results primarily through P&L and win rate? Do you have any data on the behavioral causes behind those numbers? If your win rate dropped this month, do you know specifically whether it was because your setup quality dropped, or your emotional management deteriorated, or your session timing shifted? Without process metrics, you are flying blind to the causes, and that means every improvement attempt is a guess. Why it happens psychologically. Traders focus on outcome metrics because outcomes are the visible, emotionally significant, universally understood measure of trading success. Profit and loss are concrete. They are real money. They are the number your broker shows you every time you log in. Of course, that number commands attention. It is emotionally weighted in a way that process metrics never are. But here is the problem with outcome focus in a probabilistic environment. Individual trade outcomes and even weekly trading results contain significant random variance. A correct decision can produce a losing outcome. An incorrect decision can produce a winning outcome in the short term, which is the only window most traders review carefully. Outcome data is noisy enough that it can actually mislead you about what is working and what is not. Process metrics. Execution rate, deviation frequency, emotional state tracking, session quality scoring. Measure the actual behaviors that drive outcomes. They are the inputs. P&L is the output. And in any system, improving inputs is the only reliable way to sustainably improve outputs. Focusing exclusively on outputs while ignoring inputs is like trying to improve a recipe by only tasting the finished dish, without ever examining the ingredients or technique. There is also something called measurement reactivity. What you measure, you manage. When you measure P&L exclusively, your behavior becomes oriented toward P&L in ways that are often counterproductive. Chasing recovery, taking excess trades to hit targets, managing risk poorly because the focus is on the outcome rather than the process. When you add process metrics to your measurement system, your behavior automatically begins to orient toward process quality, which is exactly the orientation that produces better outcomes over time. The exact fix: add 4 process metrics to your review system starting this week. These sit alongside your existing P&L tracking. They do not replace it. They explain it. Process metric 1. Execution rate. The percentage of your trades that fully met all of your entry criteria, calculated after every session, tracked weekly. A rising execution rate means your discipline is improving. A falling one identifies where to focus. Process metric 2, deviation log. Every trade where you deviated from your plan gets a one-line entry describing the specific emotional state that drove the deviation. Over weeks, patterns emerge. 2 or 3 recurring triggers will become clearly visible. Named triggers become addressable. Unnamed triggers repeat forever. Process metric 3. Emotional state at entry. For every trade, rate your emotional state as one of three options: calm, slightly anxious, or reactive. Track this weekly. You will almost certainly find that your calm state entries significantly outperform your reactive state entries. That data tells you what your pre-session protocol needs to achieve. Process metric 4. Session quality score. At the end of every session, rate the overall quality of your decision-making on a scale of 1 to 5. Not the P&L, the decisions. Were they clear, deliberate, and plan-driven, or scattered, reactive, and emotional? Track this weekly alongside your P&L. The correlation between session quality scores and P&L outcomes is the most useful data most traders have never collected. Lauren built this tracking system. After 8 weeks, she had data that her 16 months of outcome-only tracking had never produced. Her execution rate was highest on Tuesdays and Wednesdays, and lowest on Mondays and Fridays, suggesting that her emotional state was most stable midweek. Her most common deviation trigger was impatience after 60 minutes of watching without a valid setup. Her calm state entries had a win rate of 68%. Her reactive state entries had a win rate of 29%. Every one of those data points was directly actionable. Her results in the 2 months following the data collection were the best consecutive months of her trading career. Add process metrics alongside your P&L tracking. Execution rate, deviation log, emotional state at entry, session quality score. These metrics explain your results rather than just reporting them. When you measure what causes the outcomes, you finally know what to change, and change becomes directional rather than guesswork. Let me tell you about Kevin. Kevin is 31 and has been trading on and off for about 4 years. Not consistently, on and off. He starts with genuine commitment. He learns, he trades, he has a period of progress. Then something goes wrong. A blow-up, a losing streak, a life event that disrupts his routine. He steps away. Sometimes for weeks, sometimes for months. Then he comes back, he restarts, he relearns, he has another period of progress. Then something goes wrong again. The cycle repeats. After 4 years of this pattern, Kevin's actual accumulated trading experience, if you removed the gaps, is probably equivalent to about 8 months of consistent practice. He has none of the benefits that come from sustained, uninterrupted engagement with a single trading approach over a meaningful period. No deep intuitive understanding of how his system behaves. No long-term equity curve to learn from. No accumulated self-knowledge built through hundreds of consecutive reviewed sessions. He keeps restarting. Every restart costs him the compounding value of everything he had built before it. Here is what makes Kevin's situation particularly difficult to break out of. His quits are never framed as quits. They are always framed as strategic pauses. I need a break to reassess. I am going to take some time to study before coming back. The market conditions are not right for my system right now. These framings feel responsible. They sound like the decisions of a thoughtful, self-aware trader. But their functional effect is the same as quitting. The accumulated momentum of consistent practice is interrupted. The behavioral habits built through repetition begin to fade, and the restart begins from a lower base than where the pause started. Kevin is representative of a pattern I have seen in trader after trader. The ones who never become profitable are not always the ones who stay in and keep losing. A significant number of them are the ones who keep leaving just before the inflection point, where their accumulated experience would have tipped into consistent performance. Trading competence is built through compounding practice. Every quit, regardless of how it is framed, interrupts that compounding and sets the counter back towards zero. Think about your own trading history. Have you had periods away from trading that you described as strategic pauses, but that were functionally exits driven by emotional exhaustion or discouragement? Have you come back from those pauses and found yourself essentially restarting rather than continuing? How much compounding practice time have you lost to exits that felt strategic but were actually emotional? Be honest. Why it happens psychologically. The quit and restart cycle is driven by what psychologists call the pain of effort threshold. Developing a complex skill requires sustained effort through periods of frustration, failure, and slow progress. During these periods, the brain's discomfort response builds progressively. At a certain point, the pain of effort threshold, the discomfort of continuing exceeds the motivation to persist. And the brain generates a compelling narrative for stopping that protects the person's self image. The narrative is never "I am quitting because this is hard and I am discouraged." It is always something more strategic sounding. "I need to reassess. The timing is not right. I need more preparation." There is also a phenomenon called the proximity illusion in skill development. Progress in complex skill development is rarely linear. There are long plateaus punctuated by sudden step changes in capability. During plateaus, which can last weeks or months, it appears from the inside that nothing is improving. This appearance is often incorrect. The plateau is typically a period of consolidation, where improvements are happening below the level of visible performance. But because the progress is invisible, the plateau period is when discouragement is highest and the pain of effort threshold is most likely to be crossed. Traders who quit during plateaus quit precisely when continued practice was most likely to produce the next step change in performance, the exact fix. Two specific structures that makes sustained engagement possible even through the most difficult periods. Structure 1 is the minimum viable practice commitment. Rather than committing to a level of engagement that requires peak motivation to maintain, and that collapses when motivation drops, you define a minimum viable practice level that you commit to sustaining regardless of emotional state or recent results. For most traders, minimum viable practice looks like this: one session per week minimum, one end of session review minimum, one Sunday performance check minimum. Not optimal trading. Minimum viable engagement that keeps the compounding clock running even through difficult periods. The minimum viable commitment is not what you do when you are motivated. It is what you do when you are not, and it is what prevents the restart cycle from repeating. Structure 2 is a specific protocol for difficult periods that replaces the quit narrative with a structured response. The difficult period protocol has 3 steps. Step 1. When you feel the urge to take a strategic pause, you are required to wait 5 trading days before acting on it. No immediate exits. 5 sessions of continued minimum viable practice with the documented intention to pause. Step 2. During those 5 sessions, you implement the smallest possible version of your trading. Minimum position sizes. Maximum 1 trade per session. No new system changes. Step 3. At the end of the 5 sessions, you evaluate whether the urge to pause has changed. In the majority of cases, the 5 sessions of continued engagement, especially at reduced stakes, resolve the emotional state that generated the pause urge without requiring an actual break. Kevin built both structures. His minimum viable commitment was 1 session per week with a 10-minute review. His difficult period protocol replaced 3 separate quit decisions over an 8-month period. Each time the 5-session continued engagement period resolved the emotional state that had been driving toward a pause. At the 8-month mark, he looked back at a continuous equity curve for the first time in 4 years of trading. His results in months 6, 7, and 8 were the best of his trading life. He had not found a better system. He had simply stayed in long enough for his accumulated experience to compound into the performance level it had been building toward throughout the previous months of plateau. The traders who become consistently profitable are not always the most talented. They are not always the most educated. They are almost always the ones who stayed in long enough, consistently, through plateaus and difficult periods and bad months, for their accumulated practice to compound into genuine competence. Competence in trading, like competence in any complex skill, is not a switch that flips on. It is a threshold that is crossed when accumulated practice reaches a sufficient level. Every trader who quits before that threshold does so without knowing how close they were. Some of them were days away, some were weeks. The only way to know you have crossed it is to still be there when it happens. Define your minimum viable practice commitment and honor it regardless of emotional state or recent results. Build a 5-session difficult period protocol that replaces quit decisions with structured continued engagement. The traders who become profitable are the ones who stay in long enough for accumulated practice to compound into consistent performance. The threshold is real. You cannot know how close you are until you cross it. 3 reasons most traders never become profitable. 3 specific, concrete fixes. Reason 1. They keep learning instead of implementing. More knowledge is not the answer when the gap is between knowledge and behavior. The fix is a 30-day implementation moratorium. Pick one rule you already understand, but do not consistently follow. Stop all new information input. Build daily accountability around that one rule. 30 days of behavioral practice on a single principle produces more progress than 30 days of consuming new content. Brian followed the 1% rule consistently for 30 days for the first time in 3 years. His account grew, not from new knowledge, from finally acting on the knowledge he already had. Reason 2. They measure the wrong things. P&L and win rate tell you what happened. They cannot tell you why, and without the why, improvement is guesswork. The fix is adding 4 process metrics: execution rate, deviation log, emotional state at entry, and session quality score. These metrics explain your results rather than just reporting them. Lauren's 2 best consecutive months followed 8 weeks of process metric tracking that finally gave her actionable data on the specific behaviors driving her outcomes. Reason 3. They treat trading like a sprint and quit just before the finish line. The quit and restart cycle interrupts the compounding of practice and resets the counter repeatedly. The fix is a minimum viable practice commitment that sustains engagement through low motivation periods, and a 5-session difficult period protocol that replaces quit decisions with structured continued engagement. Kevin built both and sustained the first continuous 8-month engagement of his 4-year trading history. His best results came in months 6, 7, and 8, months he would not have reached under his previous pattern. 90% of traders never become consistently profitable. The 10% who do are not smarter. They are not more talented. They are not luckier. They implement what they know instead of endlessly learning more. They measure what causes their results instead of just recording them. And they stay engaged long enough, through plateaus and difficult periods, for their accumulated practice to compound into the consistent performance that was always the destination. That destination is available to you. These 3 fixes are the path to it. If this video gave you a clearer picture of exactly what is keeping you stuck, subscribe right now and hit the bell. Every single week I post content at exactly this depth. No recycled tips, no income screenshots. Just the honest, specific, psychology-based education that helps real traders actually develop. And in the next video, I am going to show you how to build your first complete trading plan from scratch. Every section, every question you need to answer before placing another live trade. The exact framework that takes you from reacting to the market to operating with a system you can genuinely trust and consistently follow. That is the foundation video. Subscribe. Do not miss it. See you there.